Hello, everyone, and welcome to At Barrons. I'm Andy Serwer, and welcome to our guest, Mike Gitlin, CEO of the Capital Group. Mike, nice to see you. Of
Thanks for letting me be here with you. Appreciate it.
course. So, why don't you tell us a little bit about the Capital Group? It's obviously a big mutual fund, complex company based in LA, been around for a long time, but give us a lowdown.
Sure. Well, mutual fund and a lot more now. So, the way in which we think of ourselves as a global asset management company, been around since 1931. So, our long term strategic plan is our 2031 plan, having it be our centennial. We have 9,500 associates. We're in 32 cities around the world. We manage just about $3 trillion of client assets, predominantly active. And the long-term approach at capital is something folks know us best for in terms of just how we manage money, how we think about managing client assets. But I'm sure we'll get into that. But it was always, it came out of the Great Depression, and the founder wanted to think much longer term than short-term market turmoil.
Yeah, you anticipated my question, which is this investing philosophy, which is kind of a hallmark of your company. What is that, Mike?
Well, it's known as the capital system. And I can brag about it because I was minus 12 years old when it was formed. In terms of 1958 was the initiation of the capital system. The way in which we manage money, and it really has three hallmarks. One is collaborative research. So what does that mean? Analysts manage money. They're not saying buy, sell, hold. They manage real client assets. It's very different when you have skin in the game and you're managing risk, you're managing portfolio construction, you're dealing in new issues. It makes you an investor, not a stock or credit rater.
Mhm.
The second part of that is diverse perspective. So not only are the analysts managing money inside of the portfolio, but you may have multiple portfolio managers in the same strategy. And the reason we do that is so they can all express high conviction. The way it was framed to me, which I repeat, is you're not left with one individual's 300th best idea. You get conviction in the portfolio. That's really important. And the third hallmark of the capital system is long term. Folks say long term, but it's not long term unless you measure it that way. If you look at our analysts and portfolio managers, the number one driver of their quantitative bonus is their 8-year number. The lowest driver, the least driver, is their 1-year number. So it's 8, 5, 3, 1. And the 8-year number is more than half of the formula. So if you want to incentivize long-term outcomes, you have to do it through your own incentive system. And that's why the 8-year number is the most important.
Yeah, I know you guys have some really strong retention rates, knowing some people who work there. And Gordon Crawford,
Gordy
one of your
Crawford
famous
is,
guys who worked
yeah,
there, was there for a
absolutely.
long, very long time, right?
People stay. We have very low turnover, low single digit attrition in investment professionals. People come early and stay long. So it's not abnormal to have our investment professionals retire at 65 years old after a 30, 40-year career.
And your products are sold through the broker, that model, right?
Yeah, the way in which we frame it is individuals are best served through financial advisors.
Mhm.
So we don't quote unquote sell direct. We support financial advisors who support their clients. That said, we think of their clients as our own as well, which is part of the whole capital group trust and integrity process. But it is the financial advisors in the wealth world. It's their client, and we help service the financial advisor to make sure they're getting the right solutions.
Now, you've been CEO since what, the fall of 2023?
Yes.
What's your strategy? What are you doing?
Well, what I'm doing is what we're doing. We're not a super hierarchical company. We have three senior leaders. Then we have a management committee of 10 folks. So I'm in the CEO seat, but we're really managed by a group of folks. Our strategy, if you look at our long term strategic plan, it's fourfold. So, one, investment results. That is what we do. We have to beat benchmarks and we have to beat competitors. And that's our focus. It's about outcomes, first and foremost. The second thing is evolving with clients. What do they need? Vehicle of choice. At the beginning, you mentioned mutual funds, yes, and ETFs, and collective investment trusts, and SMAs, and institutional separate accounts. We have intellectual capital. How do they want to consume it? We have to make sure we have it available for them, the financial advisors, and how they'd like to consume it. And then we have to be a really good business partner. So, thought leadership, practice management, portfolio construction. How do we make the financial advisor even better at what they do? Third is simplify and scale. Every company's trying to simplify and scale their operating model. We're no different. We've made a lot of progress, but we got some room to go on that. And the last thing, and you talked about associates staying, how is the associate experience? Lots when companies have a lot of turnover, it's costly and it's disruptive. We have very low turnover, so how do we keep investing in culture and the associate experience? That's the fourth part of our long-term strategy.
I want to get into the strategy of products a little bit and that um, part of the business going forward. You guys talk about on your website the largest active manager on the planet. But active management and mutual funds, which has sort of been the hallmark of what you do, face headwinds. And I'm wondering, what you're doing specifically to address those particular challenges.
Well, and I'll get in a little to that active management because a lot of active managers face headwinds when they have high fees and poor results. For us, we have low fees and good results, and I'll give you a couple stats on the results front. And this is investment results. That's what we measure ourselves on. If you look at our equity and multi-asset strategies, and most folks think you can't beat the market in equities because they're looking over the last decade, which has been challenging. If you look at our equity and multi-asset strategies since inception, you put them all together, 87% beat benchmarks, gross of fees, and 80% net of fees. So the vast majority of our strategies are beating benchmarks over the long term. And then relative to competitors, it depends on the time period, 10, 15, 20, 25 years. Those time periods, around 75 to 90%, depending on which time period, are first or second quartile in their relative peer group. So first and foremost, we are beating the benchmarks after fees, and we are beating competitors. That's what our clients are looking for as outcomes. In terms of vehicles and strategies, look, we have made a lot of progress on this whole concept of vehicle of choice. So how do we make sure we have whatever the advisor needs to satisfy their clients? And look, that is something that's taken years to do and to do well, because when you look at ETFs, for example, we didn't have ETFs. ETFs have been described by the whole ecosystem as passive because active managers haven't launched ETFs. Once we did, then folks said, gosh, we can find the same investment services you've had in mutual fund form in ETF form now. Thank you. And I'll just give you an example of that. 35,000 financial advisors now have used our ETFs. They weren't able to do that because we didn't have them. And about 15 to 20% of those folks are new to Capital Group in some way, shape, or form. So it's important to be vehicle agnostic and offer those and then have people consume your services. The other part is, do we integrate passive and do we integrate alternatives? In passive, we do. We now offer and deliver active passive hybrids. So active at the core is what we do. It's what we're known for. Some folks want passive and use passive. We know that. We'll take passive, we'll incorporate it into our investment solution with our own active, and passive and active make it a lower overall fee, and we'll deliver that solution to clients. And we're just about at that in alternatives with what we just launched with KKR in the last few weeks, which is a really interesting combination of active and alts.
All right, you led me to that. So
Yeah.
tell us about this new relationship with KKR. And this is obviously something that people are intrigued by in the marketplace.
When we announced it a year ago, we had a ton of incoming on it. Like, what are you doing? Why? What's the partnership? And when we were looking at alternatives, most folks were in the camp of buying someone, buying another entity, or building the capacity themselves to do alternatives. We looked at both of those. We're not an acquisitive company. Our culture is super strong, and it's hard when you acquire companies to maintain that culture. And then building the capacity, it's really hard to do and to do well. We looked at private credit. It's a banking, it's origination. We're asset managers. Instead of trying to compete with KKR at what they do incredibly well, we decided to partner with them. And what we just launched are active alt combo. So think of these as interval funds. Daily buy liquidity, sell liquidity is quarterly. And we do 60% public credit. KKR does 40% private credit. It's bringing together the best of both worlds. We have a track record in public credit. We know that very well. KKR has a track record in private credit. They've done that for 50 years. You put the combination together, It's more liquid than standalone alternatives. We put a fee on it that was intentionally very competitive. Just to give you an example, the average interval fund is just about 2.5% fee in the industry. Ours, if you look at our F3 share class and our two different services that we've offered, 84 and 89 basis points. So less than 1% versus 2.5%. So we're bringing something that's accessible, that will have better liquidity, that is more accessible in terms of fee. The solution is meant to let folks benefit from both private and public markets, but do so in a cost-effective, more liquid way.
These are funds that you made with KKR, and I can see this take a lot of work because it sounds like it's,
Yeah.
there's a lot of stuff going on there, but they're specifically for you. In other words, they're not selling them to anyone else, right?
So
They're specifically through
yeah,
you.
no,
Okay.
you're right on. I mean, we are the ones, we're co-branding them.
Yeah.
They're Capital Group KKR Solutions, but we are distributing them with our financial advisor partners. Um, and it's unique to us. So we have an exclusive global relationship with KKR.
And a lot of people, Mike, are asking, is this appropriate for retail investors? It's a big question with this new venue.
Yeah, I think one of the reasons we wanted to create this hybrid market was it lets financial advisors use alternatives for their clients in a calm way. So if it's their first foray into alternatives, do it in a way that's calm. And if it's 60% public and 40% private, you can see that journey might be a little calmer than if it was 100% private markets. So one of the reasons we wanted to do this was to say there's an opportunity in private credit for sure. Take advantage of it with Capital Group, who you know very well and who you trust. And we'll work with KKR. They're the sub-advisor. We put our heads together. We construct the portfolio, but we do it in a way that's meant to have a little bit of a straight journey, not a very complicated or costly journey. And so, yes,
Mhm.
it's appropriate. It depends on the financial advisor. It depends on the end client. It depends on their risk profile. But this is a great way to start off for a lot of people.
Morningstar has written that you guys had some outflows over the past several years, and I'm just wondering what the situation is with that at this point.
Yeah, if you look at all active equity managers, there were outflows in active equities for sure across the entire industry. Our negative flow rate was very low as a percentage of our assets under management, about 1.5%. A lot of the active managers were 3, 4, 5%. So very low in terms of our overall assets under management. And what we see is an interest in this vehicle of choice helping our flow rate, meaning as folks are able to consume active ETFs, as they use SMAs, as they use collective investment trusts, our mutual funds will always be critical to Capital Group and to our clients, but all of these other vehicles now give our clients ways to consume our services that over time will take that negative flow rate into positive territory. It's hard to predict exactly when. I would guess the next 12 to 18 months, depending on a lot of variables. But we've headed in that direction over the last few years, and we feel good about it over the next 12 to 18 months.
Are you also looking to expand internationally and with fixed income?
Yeah, fixed income, if you look back a decade ago, we had relatively low market share. And we really, and I spent, when I was hired, it was on fixed income. It was to lead
Yeah.
the fixed income group. We had great folks. We needed to broaden the number of people we had. We needed to broaden the services we offered. We've gone from 200 billion in fixed income to about 570 billion in fixed income. We've gained market share and we've had strong investment results. So fixed income has been a huge driver of Capital Group and our broader market presence. Europe and Asia client group as well. We've spent a lot of time and energy broadening our appeal outside the United States. Last year, for example, we were a top 10 net inflow manager in Europe. So we are seeing flows in Europe, we're seeing flows in Asia. It's a little less, and I know it's going to sound strange, but we measure ourselves by investment results, not assets under management or flows. We feel as if we do a good job in the former, we'll end up having more of the latter. And what we're seeing in Europe and Asia is a huge share gain with financial intermediaries, particularly in Europe and Asia.
What are your customers telling you about the markets right now?
Well, what they're telling us, and we're not seeing a lot of flows related to the volatility in the markets, but over time, whether it's customers of ours or whether it's companies that we own, what everyone wants is certainty. And it's less about the exact rules of the road. Obviously, it's important on where they end up shaking out, but investors love certainty. So just tell us the rules and we'll pivot to make sure we're able to take advantage of the opportunities we have. But investors want less geopolitical noise as much as humanly possible. They want tariff agreements around the world. And then they want to be able to evaluate companies based on the merits of those companies, less on the shifting rules around the state of the marketplace.
And what about you, Mike? Do you have a take on the markets personally, and where do you invest?
If you think about the markets, at any given time, you can look at, and this is over hundreds of years, you can look at any moment in time and say, gosh, I'm nervous. For plenty of good reasons. We've had world wars and great depressions, and anything that you look at can cause angst in your overall investment mindset. And at all of those times, it was a better idea to think longer term. And sometimes people think that's a cliche. When you say long term investing, oh, well, of course you would say that. Well, yeah, we will because over the long term, markets go up. Look at capital market assumptions. If you look at our own, equity markets may grow 6.5%, 7% over the next 10, 20 years. Fixed income markets, 4.5%. Trying to time the markets has never been a good idea. It's just not. So staying balanced is important. People try to move that asset allocation around too much. Staying balanced. I remember when people said, well, the 60-40 equity fixed income mindset is dead. It's alive and well. You need balance in portfolio. You need to own equities. You need to own non-dollar equities as well, not just dollar-based equities. You need to generate income in a portfolio. All of these things in portfolio diversification remain important today. So what am I doing? I'm in my mid-50s. If you're in your mid-50s, you need to be somewhat balanced in your portfolio diversification, and you need to have exposure in stocks, bonds, some in alternatives. Think single digits, not double digits. But if you have that kind of exposure and you don't get tempted to touch the portfolio when you shouldn't, you'll do pretty well.
I want to switch over and ask you about you a little bit, Mike. You mentioned you're a fixed income guy. You worked at T. Rowe Price. I think you also worked at Citi and Credit Suisse. Tell us about your journey and what's different about those places from Capital Group.
Well, before I was a fixed income guy, I was an equity guy. I've actually now done exactly half and half. I started my
60-40 or something,
well,
right? Yeah.
in terms of portfolio diversification, I've done career diversification. Yeah, I started off working at a small hedge fund on a trading capacity. So I was one of those people in the 90s who was in the United States trading the Asian markets overnight. So think 5 p.m. to 5 a.m., which is not a typical schedule. That was me in my 20s. I've just benefited from having a whole bunch of different experiences: buy side, sell side, hedge fund, long only, US, non US, stocks, bonds. And I always laugh when I hear people in their 20s or even 30s saying, here's where my career is going to go, because no one really has any idea. And I didn't have any idea in my 20s. I'm fortunate to end up at Capital Group. You asked, how does Capital Group compare to the others? I won't disparage any place. I had a great experience at T. Rowe Price and at Citi. Capital Group's different. We're a private enterprise, and that allows us really to think about the long term. When we talked about long term earlier for investment results and how we measure people, it's the same in how we manage our own company. And when there's market turmoil, some of our competitors have to knee jerk in terms of their reactions because they face quarterly earnings realities. We're able to say, let's think about the long term. How do we find great people during downturns? How do we invest in our business during downturns? It's a huge advantage. It's a differentiator. And what I share with our team, if you're not taking advantage of one of your differentiators, it becomes a disadvantage. So we lean into that in market turmoil. You can't tell when it's going to come, but when it does, we have such a benefit of being able to think long term as a private enterprise. So it took me a while to get to Capital Group. I didn't join until I was 45, but Capital Group stuck with me until retirement, and it's a fantastic place to be at.
And final question, Mike, and I have to ask you this. Your brother Dave Gitlin is the CEO of Carrier. So, what did your parents feed you? How is it possible you have two CEOs coming up from the
Well,
same
my
family?
my other brother Jeff as well. He's at PwC. He's done healthcare consulting for 30 plus years. Um, while he's not a CEO, he might be the most impressive Gitlin of all, Jeff. But look, we were sitting around the family table well before people had their iPads out at the table or their phones out at the table, and we would have a good old fashioned family dinner. And you had to say something intelligent at dinner. My father was a lawyer, and at the family dinner, he would raise a topic, and we'd all have to discuss it. So that forces you to be a little thoughtful. And if you had, again, just something off the cuff and you hadn't been super thoughtful, he'd let you know that. And I think those family dinners, we've tried to do it in our family. My kids are older now. They're 23 to 27, 23, 25, 27. But my wife and I tried to do the same thing as much as we could is how do you have a calm family dinner where you're able to talk about something substantive in the world? And today it's harder with all the distractions. I don't know how parents do it today. It's a lot harder, but if you can carve out some time just to be thoughtful, good things can happen.
I'll have to follow up and see if your kids become CEOs themselves, right?
Yeah, we'll see.
We'll see. Mike Gitlin, CEO of the Capital Group. Thank you so much for your time.
Thanks for having me. I appreciate it.
This is at Barrons. I'm Andy Serwer. We'll catch you next time.